Well, let's go back to the other tech sector and particularly the earnings that we saw last week. Some pretty big numbers. Not all of them went and impressed the market though. So let's bring in our next guest and see what is on his radar. Lachlan Hughes from Swell Asset Management joining us on the program. Lachlan, good to go and see you there. We've seen it now. The tech titans have gone reported. What was the undisputed highlight for you?
Well, there's probably three main takeaways for me from reporting season. And it was cloud growth, which was strong. Supply chain disruptions, which you've talked about previously, but also Apple's privacy changes to the latest iOS 14. And if we want to unpack the cloud growth, phenomenal numbers for both Amazon and Microsoft. And if we look back 5 years, the one thing we'd always hear from companies was the idea behind moving to the cloud was driven by cost. Well, that's just not the factor we're seeing today. So most people are moving for agility. They're moving for security, and we're seeing it across a number of the big names out there. So SAP, Oracle, Workday, all moving to the cloud, which is driving very strong numbers for these big cloud players. And then secondly, in terms of the supply chain, as you mentioned, supply chain disruptions affecting a number of the companies in the FANGs. Apple obviously had issues in sourcing chips, which slowed sales slightly. Facebook, interestingly, companies pull back on their advertising spend because inventories were lower. Well, guess what? When inventories are lower, you're not going to advertise. So we saw it there. And lastly, Amazon had issues moving stock to distribution centers where they could find the product to meet the demand. So it really, supply chain disruptions was a key feature. And then lastly, in terms of the privacy changes hurt a number of the advertising businesses, particularly Snapchat, which I guess ahead of the call had thought they had the problems under control. It turned out not to be the case. Facebook, on the other hand, had flagged slowing revenues as a result of the changes to iOS, and the market was slightly kinder to them. But Alphabet, I guess, showed its resilience and delivered very strong numbers across the board.
So from a bigger picture investor point of view, everyone's now talking about rate rises. Does this threaten, the growth industry? But something like, Microsoft has been through 1,000 interest rate cycles and it still manages to power ahead. So what sort of conversations do we have about big tech and rising rates?
Yeah, it's a good question. I think rising rates affects valuations for all companies, and it affects companies which have higher growth prospects. So that includes the FANGs. But what I would say, we personally believe the inflation will be transitory, but if we're wrong, which we may be on inflation, we want to be invested in companies that can raise their prices with inflation. And I believe with the value that each of these FANG names delivers to the end customer is so significant that they will be able to raise their prices with inflation. So you'll get a benefit there. But it's always something that the market's focused on, but it's always hard to know what's going to happen with inflation. This seems different to the past. This is very much supply-led inflation. I think once the supply chain clears out a little bit and demand rolls over as we come out of this kind of high growth phase from exiting the pandemic, you'll see inflation start to come back, and we're going to go back to the old favourites, which is looking for companies that can grow irrespective of the macroeconomic backdrop. And we believe at Swell that all of these FANG stocks will continue to grow in an economy that is moving up very slowly.
So in terms of the composition of, we keep talking about FANG stocks, does it actually matter what parcel we put it together? But it does mean that nearly a quarter of the index is run with these tech titans.
Yeah, absolutely. And it's only getting bigger, and I think it's going to get bigger again in the future. As you called out, Microsoft's now a $2.5 trillion company. But you've always better, we think as investors, rather than focusing on the size of the market cap, it's important to look at the market. And if you look at cloud, for example, this has a huge runway of growth ahead of it. It shows absolutely no signs of slowing. In fact, we're even seeing an acceleration of shift to the cloud. So this is one thing that investors should do, which is focus on the key drivers. And the key drivers for each of these companies is strong. You take a company like Netflix. They've got around 220 million subscribers. Now, we expect them to get somewhere around 500 million subscribers over the next 5 years. The market is over 800 million. There's 800 million households globally, ex-China, that uses cable television. And that's the end market for Netflix. So despite the fact that these are very, very large companies, there is still wonderful growth prospects ahead for them.
Well, that's because they're essential these days, aren't they? Hardly discretionary. Thank you so much. Lachlan, always joining us from that beautiful backdrop. Thanks for sharing from Swell.
Thank you, Annette. Good to be with you. Thanks, David.